All right, traders and investors, welcome back. I have on the line with us on the pre-market prep show Mike Hewson. He is a chief market analyst at CMC Markets. Mike, welcome to the show.
Yeah, good morning, Garrett. Nice to be here.
Yeah, I appreciate you coming on. Now, if you don't mind me asking, I'm kind of curious how you do some of your trading. Do you know, a lot of the guys nowadays are either using algorithms or using technical analysis. Do you use any sort of fundamental analysis? And if you do, how much or when do you use it?
I do look at fundamental analysis, absolutely. It's important that you don't disregard it, but I'm primarily a technical trader by nature. And generally, it's very, very simple. I generally look at the peaks and troughs, look for areas of congestion, and basically trade around those areas of congestion. I'm not what you might call a scalper. So basically, sometimes I'll go a couple of days without trading at all, but when I see an opportunity, I'll put a trade on with a fairly tight stop and let it run. I'll give you an example. Last week, for example, euro dollar found a few bids around about 133.30, so I put a small trade on around about 133.45 and lobbed it out 134.10 on Friday evening. So generally I tend to look for areas of support and resistance and trade around them, obviously also in line with the trend.
Right. Now, when you're doing this, do you have a preference when you're on the charts? Do you prefer to use candles or bars? And
candlesticks. I'm a big fan of Japanese candlestick charts. I look for inside days, outside days, bullish engulfing patterns, bearish engulfing patterns, dark cloud cover, piercing patterns. For example, the other day we saw a very nice piercing pattern on the German DAX, which suggested to me that we might be due a bounce. And this was on the daily chart, and subsequently we've got that, and I think we could well, on the basis of that pattern, see a move back to around about the 9,500 area.
Okay. Now, what kind of time frames do you use when you're doing this? Do you kind of step through it, maybe look at a daily chart, and then step out to a week or a monthly, and then kind of trade your setups on a progression like that? And if so, what kind of progression do you go across?
It's pretty much like that, Garrett. I look at a long-term daily chart to get an idea of where the long-term trend is. I look at the 200-day moving average, I think, because that's very, very key for me, certainly in terms of whether a market is overvalued or undervalued relative to its long-term mean. And then I drill down into a 4-hour chart and then an hourly chart just to get an idea of the short-term idea of whether it's overbought or oversold. And I use a very simple slow stochastic at the bottom just to measure whether it is overbought or oversold. But generally, if I'm near a support area, I'm not really that interested in what the slow stochastic is telling me. Let's say, for example, if it's overbought, and it's broken through a resistance level, I will still buy it because it's broken out.
Okay.
If that makes sense.
No, it does. And I'm wondering though, because you're talking about the forex and stuff. What's the shortest time frame you use or that you utilize? Because it seems like as somebody with 20 years of experience and specializing in technical analysis, it almost seems like you'd get a lot of noise if you did anything underneath a day.
Yeah, absolutely. I mean, I'll very rarely look at anything less than an hour, simply because I'm not a scalper by nature. So I'm not really interested in what it's going to do over the next 5 or 10 minutes. I'm really interested in what it's going to do over the next 2 to 3 weeks. So the short term moves don't really interest me that much. If we get near a significant support or resistance level, I'll put a trade on, but I'll wait for the market to come to me. And if an opportunity doesn't present itself, I'll sit on my hands. I found that if I trade for the sake of it, I usually end up losing money.
Okay, now if I can just backstep a moment, because you were talking about DAX and you were laying out some pretty much textbook patterns. Is there anything else that you see, looking at the DAX? Can you give me any other examples of some of these specific patterns that you see on a technical basis?
Well, I talked last week about euro dollar on a daily candle chart, and if we actually look at a daily candle chart on euro dollar over the course of the last 30 days, there was an area of support around about 133.30 at the beginning of August, and basically you can look at the daily chart from the highs in July all the way down to the beginning of August. And at the beginning of August there was a hammer, and then 2 days later that was followed by a bullish engulfing day. Now the rally for that was fairly weak. But the short-term trade, the sensible short-term trade there for me was a buy with a tight stop. When it didn't take out the peak at the beginning of August around about 134.50, I was suspicious about the strength of the rally. And when it broke back below 133.30, I got out, reversed the position, and am now sitting short with a stop loss above 133.50.
Nice. So when you have these suspicions on, are these suspicions something you keep in mind or you keep on your charts, or do you actually enter in, hard stops or hard target points where you'd like to get out of a position?
I always put in hard targets where I want to get out of a position. I'm never afraid to admit when I'm wrong, because you can never, I've never met a trader yet who's always right, because otherwise we wouldn't be sitting here talking about this. The best thing that you can do when you're a trader is to basically take it on the chin, admit you're wrong, move on. There'll always be another trade along. They're like buses.
Now with technical analysis, are you able to use these across broad assets? Can you take the same analysis that you use in a Forex market or looking at an index future and use that in stocks and ETFs, or do you have to change those up? And if so, do you have a preference between either trading FX and futures, which it sounds like you do, or some form of stock or ETF?
I pretty much prefer trading foreign exchange simply because that's my background. I used to trade FX for an Australian investment bank. So, that's my comfort zone. But they're equally, they are transferable. The skills are transferable. What I would say, though, with stocks and shares, particularly over the past 5 years, is the reversal patterns are always more reliable when the market's reversing from a steep fall, rather than the other way around, simply because the bias at the moment is to buy stocks on dips. I generally find that the bearish reversals are less reliable than the bullish reversals, and that's simply because of the amount of central bank money that there is sloshing around in the market at the moment.
It's almost providing a steady base as we continue to walk up across the entire globe. Yeah,
exactly. It's just like walking up a staircase. Sometimes you might slip down a trapdoor, but eventually you will find that there is a ledge somewhere, which leads back onto the wall of worry again.
So in your experience, have you had success then trading over a longer period of time, or do you stick with short-term trades? Do you usually look for setups that might happen within a week, or 2 weeks, or do you try to trade something on a monthly?
I'm very much, you've got to basically compartmentalize the two. You have your investment hat on, which essentially you look at long-term trades. So, for example, I've been bullish on Apple for about the last 9 months. I was on Bloomberg about 9 months ago, before they did the stock split, and it was trading, I think, just above $500. And I was I was fairly bullish on the stock, despite the fact that it had fallen quite sharply from the peaks that we'd seen around about $702 and fallen all the way down to about $450, $400. But on a long-term basis, it was still above its long-term moving average. It also corresponded, it also gave quite a nice couple of reversal signals on the candles. So I was fairly comfortable with it. But that was very much a long-term time horizon, and that's an investment horizon. You then have to take that hat off and look at the market through a completely different set of eyes when you're trading intraday, because essentially you're not really worried about the long-term direction when you're trading intraday. So your mindset is completely different.
And that's why it almost seems like it'd be a little more difficult with technical analysis, because of the jarring movements we can have. There's no time to really absorb a move and say, like, this is the psychology of the market right now. You can just look at it for a minute and say, okay, everybody sold really quick. But in the long run,
exactly.
It's tough to get that.
Exactly. I mean, with stocks, we've been in a 5 or 6 year bull trend. So there's never really been any opportunity to sort of look at bearish reversals or anything like that, because any of the ones that we have had have been fairly short-lived. Whereas with currencies, you do generally tend to get significant reliable bearish reversals, simply because central bank policy from across the world operates at what I would call has a push-pull effect in terms of the currencies, because you've got one central bank pushing or pulling against another central bank. So a good trade at the moment that I've been looking at for quite some time is the ECB, Bank of England, or the ECB Federal Reserve trade, because on the one side, you've got the ECB, who are likely to ease further, They're certainly not going to be tightening. And then you've got the Federal Reserve and you've got the Bank of England, whose next move on interest rates is likely to be towards the tightening cycle. And as such, that's really going to put downward pressure on the euro. The key, I think, at the moment has been trying to pick the top in the euro. I think we've picked the top, and now it's really just trying to pick a place to go short of it.
Do you have a view on interest rates or what you think the Federal Reserve will do or the Bank of England as far as when they will raise rates or what will happen? Do you have any sort of view on that you care to share?
I have a view on the Bank of England, and I don't think they'll raise rates this year, despite the fact that we've got dissenters not only on the FOMC but also on the MPC, the Monetary Policy Committee of the Bank of England. Really, the data doesn't support a rate hike at this point. If you look at the economic data coming out of the UK, there is some evidence that we're seeing a little bit of softening in terms of the retail sector. We had some retail sales out this morning. They were significantly weaker than I expected them to be for July. They came in at 0.1. We were expecting 0.4. And a large part of the recovery that we've seen here in the UK has been very much consumer-led. Now, if you then look at the US economy, everyone's very bullish on that. The payrolls numbers are good, 200,000 plus jobs pretty much for the last 6 months. But underlying that, Garrett, and this is where I have a concern because the US economy is fairly similar, I think, in the context of the UK economy, and it's very consumption-based. If you actually look at the confidence numbers for the US economy, they've actually been very, very positive over the past 5 to 6 months. Now, people say to me, you know, consumer confidence, they're forward-looking, improving consumer confidence, that's good for the economy. But if you actually look at the retail sales numbers for the US economy over the last 5 months, in March they were 1.5%, in April they were 0.6%, May 0.5%, June 0.2%, July flat. So they've been declining significantly for 4 months in a row, at the same time as consumer confidence is rising. That doesn't sit right with me at all. That suggests that the consumer, the US consumer, is holding back. They're saying they're confident on the one hand, but they're not confident enough to go out and spend money. If you look at durable goods, it's the same. It's very, very patchy. And yet we're told that inflation isn't a problem. Wage growth is weak, as it is here in the UK. So I have concerns. I'm not convinced that this recovery in the US and in the UK is as resilient as central bankers would like us to think that it is.
I know, and that's the same thesis I've been seeing too. Even spending and saving levels have kind of been a conflicting story here in the U.S. And even touching on retail softening, has there been any excuse? I like to use the phrase that here in the U.S. we use the excuse that it's the weather that has been dampening economics because it seems to be some sort of new thesis. So I'm wondering if over there with retail sales down,
you can always blame the weather, Garrett. You can always blame the weather. But your strongest retail sales growth this year was in March, plus 1.5. No, well, yeah, plus 1.5, and then in February, plus 0.9. Well, I thought you were basically buried under about 20 feet of snow then.
Yeah, I know. That's what well, that's what I'm wondering, because, I mean, we look at the data, and there's such a dynamic at play here because there seems to be such an anchor to the way that the economy had performed before 2007, and these are periods of when there was a lot of excessive credit in the system. So it seems like what would be normal now is obviously going to be below what was normal in 2007, but there seems to be a disconnect with people trying to adjust those viewpoints. So we're always expecting the same numbers we had back then, and it's just not going to happen with the dynamic of, you know, the retail market now. Even with consumer credit increasing, it seems like debt levels are kind of lightening on the households.
They're lightening a little bit, but I don't think they're lightening enough. And they're certainly, they're lower here in the UK than they were, say, 5 years ago. It's come down from about 180% of GDP to about 144%, but that's still fairly high on a historical basis. And I think a lot of the wealth effect, if you like, here in the UK is based on house prices in the same way that it was based on house prices in the US. Now, you saw a proper house price correction over there in the US, which we didn't really get. So I think in terms of indebtedness, we're probably behind you in terms of recovering from that. But, you know, when I look at the labour participation rate in the US and compare it to the participation rate here in the UK, there does seem to be a significant disconnect between the two economies in that context because, we've got record employment here in the UK, and yet you've got record low participation there in the US.
Yeah, and it's going to be pretty interesting to see how these dynamics wind up playing out over the longer run. So what I'd like to touch on, if we could bring it back then, we've talked about the dynamics and the things that can happen on the fundamental basis, and then you being a strong technical trader. And I'm sure you remember when you first got into it, some of the technical trading terminology may have seemed a little over everybody's head or a little too much to take in at once. So I'm wondering if you have any ideas for a way a novice could learn about technical analysis, if there's any books that maybe you found beneficial through your experience that helped you, understand this form of trading better in light of, what drives, price movement.
Yeah, I mean, the first book I read on technical analysis was written by a New York Institute of Finance professor called John J. Murphy. It's the Bible, I think, for technicians like myself, and it's called Technical Analysis of the Financial Markets. And for me, it's a very, very good guide and a good introduction to modern-day technical analysis. And it's certainly the first book. It was the book that I found the most useful, followed by, obviously, Japanese candlestick charting techniques by a certain Steve Nison. That's Nison. So those two books combined with just basically hands-on experience of trying things by trial and error. And what I generally tend to do is I try and keep it as simple as possible. If I look at a market and I'm looking to get involved in it, I have to make a decision. Is this market going up, down, or sideways? Very simple, very straightforward, and then look to get in on the underlying trend. Now, if it's going up, I'll look for a pattern as to whether or not, where the troughs are, and draw a line through the lows. And if I'm looking to sell into a market that's going down, I'll draw a line through the highs and look to sell into the peaks. It's no more complicated than that. Certainly, I think if you're starting out, it's important that you set yourself a solid foundation. A lot of the common mistakes we see here at CMC Markets with novice traders is they'll latch on to an indicator that's being used, say, for example, like a MACD, and try and focus on that without actually understanding what actually a MACD does, and understanding the fact that it won't always work all the time, and it's a slightly complex technical trading model. I would much rather that they focused on the basics first and then basically built up to a MACD and understood it a little bit further, because MACDs, by definition, they're trend following. So if the market is not trending strongly, you're going to get an awful lot of false signals, particularly if you trade against the underlying trend.
All right. Well, thank you for that. And then I guess, we'll wrap it up here with one last question. If I could just get a short-term or and obviously a long-term outlook on the markets, if you could offer either of those, whether it's going to be just what you're trading, if you have a view on the U.S. or, over in England or Germany. Is there anything you'd like to share that you see coming up?
Yeah, sure. I mean, basically, I'm a little bit conflicted about the markets at the moment. Certainly the S&P, I think there's going to be significant resistance at 2,000. I'm very cautious about being long at these levels on the S&P, simply because there's a divergence between what US markets are doing and what European markets are doing. European markets have already rolled over, and they're all below their 200-day moving average, which suggests to me that the next risk move for European markets is to the downside. US markets, on the other hand, are still above their 200-day moving average, and I am concerned that they may have one last push higher before they roll over again.
All right. Well, thank you, Michael. Okay, so everybody, this was Michael Hewson, Chief Market Analyst at CMC Markets. Michael, I appreciate you coming on and sharing your opinion with me. Thank you very much.
Thanks very much, Garrett.
All right. Have a good day, my man. Cheers.